Good morning, everyone. This is the third part of our retirement seminar, exposing the myth of retirement investment. And the financial advisor, Mr. Emerson Hartzler, will lead the program. Mr. Hartzler, the stage is yours.
Thank you so much. Let me get a screen sharing going. And you should all see a screen that says exposing the myths. There you go. All right, so this is the third of 3 sessions, and we started out with a quotation from Warren Buffett as our ultimate financial advisor, which, you know, his rates were too high, so you got me. But he made 4 recommendations in many speeches that I've heard. And it says, you know, if you are, unless you're Warren Buffett or someone like him, 98% of us ought to be investing in this manner. And he had 4 recommendations: use low cost and funds, diversified, lots of companies, index funds that are mutual funds. So mutual funds that are low cost, diversified, and index funds. So we tried to unpack each of those things and ask the question, well, what is he saying? What do these terms mean? And then what's the evidence? Why did he come to that conclusion? And then thirdly, what does that have to do with your own strategy for investing as a senior, as a retired person, and so forth? So mutual funds we defined as funds that you can buy shares of that own in turn many, many other companies, so that you are highly diversified. You own lots of companies. Any one fails, you're not. It's not a problem for you. If there are several companies that do very well in a given year that really drive up the whole stock market, you're going to participate in it. You're going to get those. Index funds are those that aren't actively managed. They aren't picking which stocks. They're just buying all the stocks that are in an index, and in essence, buying the entire market. And then the whole cost is very important, because these things, all this management can get expensive. And we said, you know, a normal financial advisor will charge about 1% per year of your outstanding balance to do all the management things that he or she does. Then an index fund, probably his 0.1% to 0.3% on top of that. So your all-in costs of management should be somewhere around the 1.1 to 1.3% of your outstanding balance per year. That's reasonable. Most people are paying a lot more than that, and that is a problem. So that's how we started out, and we'll keep coming back to that. Let's go through here real quickly. Yeah, so the first thing we're going to talk about is the withdrawal rate, and we're going to end the session today with a detailed analysis of what that really looks like in the real world. But needless to say, when I was 65 years, 7 months into my life, I decided that was the time, because Social Security kicked in for me, I had Medicare and so forth, and it seemed like a reasonable time, and I thought I had enough money set aside to invest that I could get by. So we put together a financial plan, and we targeted a percentage of that investment that I could withdraw at a rate every year. So I had an annual withdrawal rate. Now, so I stopped putting money in, and I started taking money out. And that's a real shift in how you look at your investments over time. And as we'll talk about later, I chose the second worst time in my lifetime to retire, because what you do not want to do is retire at a time when the market immediately goes down and the money you thought you had, you didn't really have. We'll talk some more about that. So then I was kind of concerned, and I started doing a lot of work, and you'll see the effect of that, the end product of that later on in the proposal. But the point is, you should have a financial plan and it should say, here's what you can reasonably withdraw every year and not kill the goose that lays the golden eggs. So you have to be very disciplined. And we talked earlier about looking at financial statements and looking at the dollar amount in your investments and then having a reaction to it. So most people say, well, gosh, if my dollar balances have gone down, I don't feel very good about that. I feel nervous. If my balances are going up, I really feel great. But that's the dollar amount isn't really the important part, because you can't control that. The market will go up, the market will go down. Most of the time it's going up, but the downsides can be pretty rough. What you can control is the number of shares that you own. So shares are the important thing that you can manage. And so the discipline then is selling only enough shares to provide the dollars needed in the financial plan. So that's the discipline. And so, now the stock market was up in 2020. I've got an old car. Guys, I could spend 15 grand. I don't buy new cars, but I buy used cars. I could spend 15 grand to get an updated car. Guys, my balance is a lot higher than that. It's hundreds of thousands of dollars higher than it was. But I can't do that. The discipline is I'm taking out the number of shares I need in a financial plan, and that's it. I'm not going to sell for any other reason. So you have to have an absolute commitment. And if it's in your financial plan, it should all work for you. But it's the withdrawal rate. We'll talk some more about that later. But once you've established it, you have to have that commitment. You can't sell for any other reason. You can't sell because the market goes down and you panic. You can't sell because the market goes up and you think you're rich. You're not. So that's the basic discipline in retirement. Now, as a full disclosure, I did not really utilize a financial planner until I was in retirement. And that was a huge mistake. As I look back, I had a number of situations in my life where I made mistakes. And a couple of them were pretty big mistakes. And I'm pretty sure that in each case, if I had an advisor, if I had somebody to go to who wasn't emotionally involved, it wasn't his money or her money, they were just advising me objectively, I probably would have done something different, and I would have avoided a lot of pain, in one case, considerable loss. So a financial planner is very important. Earlier is better to engage someone to do that. We talked about the human emotions, and a financial planner has significant expertise in the mechanics, in the markets, in mathematics, and so forth. But the real problem in terms of investing is human emotions, and we talked about that earlier. Fear, when the market goes down, I'm afraid, I want to sell out before I lose everything. And then when the market's going up, we have this thing called greed. So, I want to get my share, so I buy as the market's going up, and I sell as the market's going down. And that's just disaster. Okay, you need to buy low, sell high, not buy high and sell low. So a financial advisor, perhaps one of his most significant contributions is just to provide an antidote to fear and greed. Most good financial planners will do what they call fire drills. So they'll say, okay, now we're doing great, but just remember the market will enter a bear market phase. It will go down. What are we going to do when it goes down? Let's practice. We're going to stick with a plan. We're not going to panic. We're not going to sell out. We're not going to do anything different. So we have the fire drill. When the fire comes, we know what to do. And then when the market's really going great and you come in and say, well, now I have a lot of money, I can do things differently. No, you have a plan. The market's up, but it's the price of things, which is nothing you can control. Don't get greedy. Don't try to go against your plan. Just stay steady. So they're going to counsel you, and they're the antidote against the fear and greed, the things that are really going to sink you. Secondly, I would always recommend going to someone who has this designation behind his or her name, CFP, Certified Financial Planner. That's a discipline like a CPA. You have to go through, you have to do a lot of testing, you have to have experience, and they have what is called a fiduciary responsibility. They are required, or they'll lose their license, to act in the best interest of the client always. And one of the things that we'll talk a little bit about more today is that there are lots of temptations in this industry. If you're a financial person, if you're a financial advisor, there are products you can sell, there are recommendations you can make that are going to make you a lot of money. There may or may not be the best thing for the client. Maybe a good thing, but not the best. Well, CFP has a fiduciary responsibility. They must act in your best interest in every occasion. And if they get caught doing it, not doing that, then there's heck to pay. And then most people think of a financial advisor as an investment advisor. And there are a lot of those people out there, not CFPs, but other people who say, well, give me your money, I will invest it wisely for you. And they really don't get involved in any other parts of your life. There are many other services that a financial planner does. There are 7 areas, the ones I use, they have 7 areas. They look at your lifestyle, they look at savings, they look at investing, they look at giving, your risk management, what insurance you should have, your estate plan, tax planning, things like that. So there's a lot of things going on with a CFP. Investments is important, but it's only one of about 7 different things they do. The going rate, as we talked before, is about 1% per year. If you've got more than $1 million invested, everything is pretty much negotiable above that line. And if you have smaller amounts, the percentage might go up a little bit, but that's kind of the going rate. So if you engage somebody, that's 1% of your investment balance each year is going to be a normal fee. So that's the CFP, very important. I wish I would have used them earlier, but I'm glad I did when I did. I would be remiss if I didn't spend some time in this whole discussion talking about annuities, because annuities are commonly sold to people who are nearing retirement or in retirement. And I think in many cases, unfortunately, they're sold for all the wrong reasons. There are some advantages and some reasons why you would buy an annuity. That's, you're buying something, you're turning your money over to somebody else who is going to give you a guaranteed predictable income. So most of these are sold in the fact that, don't take the risks of the market, give your money to me. Usually these are big insurance companies, and we will give you a guaranteed predictable income. This is like kind of buying a defined benefit pension plan. We talked about the 2 types of pension plans earlier. One is defined benefit. That's going away. People who signed up for, to work for the Santa Fe Railroad when they were 20 years old, worked for 30 or 40 years, Santa Fe paid them a pension. Capers for school teachers, things like that. That's a defined benefit. Most companies now have turned to 403Bs, 401Ks, where it's a defined contribution. They define how much the company is going to give you. It's your account and you manage it. You're responsible for it. So many people are nervous about that because they don't understand investing. They're scared of the stock market and so forth. So this is a very, very attractive thing for them. Anytime you say guaranteed predictable income, they say, well, yeah, I'd rather have that than take chances. So that's why they're sold. I think in many cases, it's just because the people who are selling it are too lazy to educate people. So they say, okay, we got the solution for you. Now, there are riders that you can have. If you need and you can't get life insurance, there's a possibility you can get a rider on an annuity that will provide that. And the same thing with long-term care. If you need long-term care and you're not in the position to buy it, you have a health problem or so forth, lots of times you can put that rider on an annuity and you can get that long-term care insurance. So those are the pros. The cons are many. These are very complex instruments. I've seen annuity contracts that run 30 and 40 pages. And if you can't explain it to me in a page, I don't understand it. And in many cases, I think the people who are selling it don't really understand what it is. They're very high fees. The people who sell these things get a huge commission right off the bat. As soon as you sign that contract, they're getting paid a lot of money. I don't begrudge people for making a living, but the fees are high. And when you say guaranteed predictable, they're going to charge you for that. So the returns you're going to get, they're going to have to take your money, they're going to have to invest it like you would. They're going to have to make a profit, they're going to have to pay their overhead. And so the return they're going to give you has to be less than they can make. And I would submit that you can make just as good a return as any insurance company can make by following Warren Buffett's advice. There's less flexibility. Once you buy one of these things, you're in there. If you want to get out of it in the first 8 or 10 years, there's a nasty little thing called a surrender charge, and you're going to pay them a lot of money to get out of it. And they're, again, highly complex. I don't like highly complex. I like simple. So I think in most cases, these, I've seen a number of these. I'm not an expert on it, but all the ones that I've ever seen, I've said, you know, if I had to advise you before you bought this, I would advise you not to buy it. So I just think it's one of the abuses. There are situations where it's the right thing to do, but I think in most cases it's not. Now, here's one of my favorite things to talk about. And when you hire a CFP or any kind of an advisor, they will give you investment statements. I've had many people come to me and say, would you look at my investment statement? Because I just, you know, it's many pages long, and there's all kinds of numbers. I just don't know how to interpret it. And you know, I say, well, I don't either. Most of these investment statements, and I'll show you mine later on, they need to be simple. They need to give you things that you should know, and most of them do not. So this is something you could take notes on, really, because there are, I think, 4 things that every investor should know and should get from their financial statements, their investment statements. And most of the time, these aren't available to you. The first one is one we've been talking about through these 3 series, and that is the investment strategy recommended in line with the Buffett recommendation? And if you go back, it's, you know, low cost, index mutual funds. And about 80 to 85% of the mutual funds that are out there are not low cost index funds, they're higher cost actively managed funds. So in many, many cases, this is going to be a no. And I think it should be a yes. Secondly, what is the cost? I mean, what is the total amount I am paying for all of this investment management? And I'd like to have it in dollars, and I'd like to have a percentage of the investment balance. Now, if you have an investment advisor, he's going to charge you the 1% or whatever. That's pretty clear. When you get into mutual funds or many other investments, many of the expenses just come out of your balance. And what you see is the net amount. And so getting to the total amount that you're paying is very difficult in most cases, but it shouldn't be. The investment advisor, the mutual fund manager, they know what their costs are. They know how much they're taking out, but they really, in most cases, don't want to tell you. So your CFP should say, here, I can show you what the total amount is that you're paying. Here's what you're paying for me. Here's all the fees that are coming out, trading costs. There are all kinds of hidden fees in mutual funds, but here's what they are. And here's the total dollar amount. And here's the percentage of rebalance that you're paying every year to manage your money. That information is known. It is generally not presented in investment statements. Then thirdly, I want to know what my average annual rate of return since the current investment strategy was put in place. So I've hired you as a CFP. You've advised me. We've got all these investments. Okay, what's my average annual rate of return? And the longer that period of years is, the more significant it is. So you see a lot of advertisements for mutual funds or other investments that say, you know, we've had a great run the last 3 years. We've had 12% rate of return. Well, that's meaningless because any 3 years could be great. Any 3 years could be bad. What we're looking at is long-term strategies. I don't know what my rate of return is going to be over the next 20 or 30 years. Okay. Well, no one's going to predict that. But if you do index funds that mirror the market, you can look at what the market has done and have a reasonable expectation for the future. But they should report that, and that's very difficult. My own personal experience, first time I talked to the people I used to work with at Tryon and said, well, we're going to do a financial plan for you because you're here, and we put all these numbers together. Now there's a real critical assumption. We want to know what your average rate of return is going to be on your investments over your retirement years. And I said, well, I don't know. I think I've gotten, 10 or 12% on many of my investments. And they said, well, yeah, probably on some of them you may have over some period of time, but what have you gotten? You've been an investor for 40, 45 years. What has been your average annual rate of return in the past? And I said, well, I don't know. I'll go ask my investment advisor. And I did. And he said, we don't really keep track of that kind of stuff. So then I said, well, gosh, I have this IRA, which I rolled out of a 401k, and I haven't touched that for 20 years. So I haven't put any money in. I haven't taken any money out. I can compute an annual rate of return on that with a little Excel spreadsheet. And I did. And I came back and I said, well, okay, it was about 9.5% per year. And they said, well, that sounds good. But during the period of 20 years was a really good time in the stock market. And if you had been just invested in the whole market, you would have averaged about 12.5%. So then I didn't feel so good about the whole thing. But it was difficult for me. I never did find out what rate of return was on the other investments that I had. So it's very difficult, but that should be known, and it should be reported to you. And again, the longer period of time, the better. And then finally, if in my example, I got 9.5, I was feeling really good about it until they said, well, if you used a benchmark, if you just looked at the overall market and you just had, low cost index funds, you'd made 12.5. Well, then I looked at the benchmark and looked at my average actual, and I said, now I'm not so happy. So if your investment advisor says, we're doing great, we're getting 8%, 7%, 10, whatever it is, the next question is, well, what should I have gotten if I had just invested in the overall stock market like Warren Buffett suggests? What's the benchmark? And all of those things ought to be available to you. If I can get this out here, let me see if I can. Yeah. Just show you. Here's I can make this bigger. Yeah, okay. This is probably as good as I'm going to get. This is a statement that I pulled off at the end of the year. It was 1/1/2020 to 12/30/2020. And these are all the accounts we have. Now I've got 3 mutual funds that go through each of those 3. And then I've got this is just a little savings account. But it gives me the period, that is this 12-month period, which is not really significant. I mean, it could be anything. 2020 was a pretty good year. Then it gives you a 3-year period, which is not very good because the stock market wasn't doing real good and do well in 2018, 2019. Here's the one since the inception. Now, this system was developed while I was still with these people. I didn't develop it. I hammered and tried to get them to do it, and they finally did. This goes back to about 2013. So this is about a 7-year production. So over that 7 years, I've averaged about 12 to 12.5% rate of return annually. That's the number I look at. And I would say even 7 years, that's not significant. It's a pretty good 7-year period. It did not include the disaster of 2008. So I think if that comes down to 9 or 10%, I'm going to be really happy. But here's the important point. The benchmark that I use is the world index. This is the whole market worldwide. Over that same period of time, it averaged 11%. So I'm saying, I know what my rate of return was, 12.23 was the average. And I know over that same period of time, the stock market, the way I'm invested, averaged 11.07. So I know what my rate of return was in any period, and I can dial this report up any day and get that same number. So that's the kind of report that you ought to be getting, and very, very few people have that kind of information. Very simple, very straightforward. The information is available, but most people are reluctant to give it to you, sadly. Okay. Now I've got a goofy thing happening here. So that's investment statements. And I'm gonna put this, there you go. Okay. So in summary, and all the things we've talked about over these 3 weeks is you invest in low cost, diversified index mutual funds. That's the Warren Buffett recommendation. Then we talked about risk. The next thing you do is you mitigate all investment risks. Business risks, that's the risk that an individual stock that you own, an individual business doesn't do well, you lose all your money or a large part of it. And of course, the antidote to that is mutual funds, diversification, own lots and lots of companies. I own currently about 10,000. I've owned somewhere between 10 and 12,500 over the last decade. So that you mitigate the business risk of any one company. I don't really care whether one goes out of business. The other 9,999 are going to cover it for me. The second risk is systemic risk. The whole market goes to heck in a handbasket. There's no place to hide. And here, you just need to control the number of shares you sell. Don't sell for any other reason than just to fund your plan for the year and ride it out. And then the third one is the one I worry about most of all, and that's inflation, because over time that can really eat into your investment balances if you're not investing properly. The antidote to inflation is to invest in the stock market, because that's the only thing that's really going to beat inflation over the long term. You need to engage a CFP to help manage the greed and fear and do all the other things they do for you. It's well worth the money. You need to develop a financial plan with them with a disciplined withdrawal rate. And that's the remainder of the presentation, is talking about that withdrawal rate. And then ask the 4 questions. Hold your CFP accountable. You know, are we investing like Warren Buffett says? What's my total cost? What's my rate of return over any period of time, especially the long period? And what should it be? What's the benchmark? So that's kind of the summary of that presentation. Any questions? That's a lot. We've gone over a lot of stuff. I can go back to any of these slides to look at them. So hearing none, let's get into the final section of this presentation, and that is my own withdrawal rate analysis. And when I was first with the Triad folk, they were training me on this whole art of financial planning. And so I had some questions about how I was invested. I always invested in stocks. Today, I'm 98% invested in the stock market. But there were some questions about it in the plan. And so I said, well, you know, we have bear markets and we have bull markets. Most of the time it's a bull market, things are going up. But what happens if the market really goes down? It takes a real big hit. Can I recover? And I'd just gone through a period. I retired in August of 2007, started withdrawing funds in January of 2008. And of course, we know what happened. The stock market went in one of its worst bear markets of all time in 2008 and 2009, hit bottom in March of 2009, recovered nicely after that. But that was a difficult period. So the question was on my mind, can I really come back from that? And then would I be safer if I had some bonds in the mix or some safer investments rather than all stocks? And then thirdly, how much can I really withdraw and still be safe rather than just, you know, kill the goose that laid the golden egg? And then The last one was, should I have some dry powder? Should I have some money just sitting on the sidelines, not invested, so that when the bad times come, I can use that money, kind of a safety fund. In fact, some of the gurus in the industry recommend that. Nick Murray, which is one of my favorites, guys who has great wisdom, he suggests you have the two years of withdrawal money just sitting on the sidelines, which sounds good. The problem is when it's sitting on the sidelines, which is most of the time in the bull markets, you're earning virtually nothing these days with that. So it's tough for me to accept that. So here, so I got a hold of data, and one thing nice about working in CFP firm, they have lots and lots of data. I had all kinds of data on the stock market going back to 1926. So I put together this nice little spreadsheet, and it looks pretty busy, but we'll walk through it very carefully, and you'll understand what went on. So I said, I have all this data of what actually happened in the stock market, so I can test all of these questions, all these theories against the real world, what really happened. And so I said, well, here's what I ought to do. I ought to try to find the absolute worst time periods ever in the stock market, starting with 1926 when we have good data. Look back as far as we can and look at all the worst times. Then I test this whole theory of Warren Buffett's thing. It says, here's how you ought to be invested. My thought, you ought to be completely invested in stocks even when you're in retirement years. Does that really work? Or are there some minefields here that we don't understand? If I can get through and prove this theory works in the worst of times, then in the better times, it should be golden. So I picked out the 3 worst times. And that's the worst case scenario that you see here, the second worst case scenario, and the third worst case scenario. And then we looked at good case scenarios, and it's crazy. But if I can get through these, and this is my story. I retired in 2007, started in 2008. That was the second worst time in my lifetime to retire. So my timing is awful. So the way this whole chart works is that I have a beginning balance. I picked $1 million just because it's a nice round number and it makes checking the math on the model easier. And then I picked a 6% withdrawal rate, which is my goal. So my goal is to withdraw 6% per year for the rest of my lifetime. Does that work? Well, let's look at these things. So I said, okay, here's 2000, the worst case scenario. And this is the all stock annual rate of return. This is a series of indexes that mirror the way I've invested. And it's worldwide stocks, all stock. And in 2000, 2001, and 2002, the market had 3 down years, a 3-year bear market. Terrible. Okay. So I said, okay, so I'm going to take that rate of return for the overall stock market. I'm going to multiply it by the $1,000, and obviously 2% less, I lost 2,000. And then I'm going to look at the inflation rate, and I'm going to inflate the 60,000 every year by the rate of inflation each year. So I didn't withdraw 60,000, I withdraw 61,000 or 6.1%, and I end up with a balance of 918,000. Now, if I had, if I had invested in long-term corporate bonds instead, I wouldn't have had these losses. I would have had a gain. I would have looked like a champ. So instead of 918,000, I would have had $1 million. Okay. Well, then the next year I start with 918. I lose another 6.3 or 57,000. Inflation rate's only 1.6, so I don't have to go up much. But my annual withdrawal rate is now up to 6.8%. Now I've got $798,000. 14% is really a hit. I've lost 113,000. Inflation is 2.5. I'm taking 63,000 out, and I'm down to 621. Now I'm really hurting. I would have had twice that much that had been in bonds. Again, this is the worst case scenario in 93 years. Okay. But now I've got some pretty good years coming in, and this balance starts to build. And so Now in 2006, I'm back up over what I started with. And I'm feeling pretty good because I'm taking this out every year. Now, of course, 2008 hits, 40% loss, and I'm back down to 564, and it builds gradually, bumps around. And after 20 years, I've only got half of what I started with. So that's the worst case. And the answer is I survived. I've still got $500,000. And look at that. I've withdrawn 1.5 million to support my lifestyle. So even in the worst year in 96 years, I can still survive. Now I would have been better off in bonds, but that's the only year I can find in those 93 years where that would be the case. Let's look at my particular situation, and that is the second worst case, 2008. I retired and immediately lose 40%. So now I'm down to 595 after the first year, less than half as I would have had here. But of course, 2009, 2010, 2012, 13 were all good years. This balance builds. I go over my $1 million in 2017, take a little hit in 2018, 2019, I'm back over $1 million. I don't have 2020 numbers yet, but it was about a 15 to 17% increase. So this number is going to go up considerably. And that's pretty much been my experience in those years. And again, I would have been a little bit better off in bonds for that 1 year, but not much. And I think at the end of 2020, I'll eclipse what the bonds are doing. Now that's the worst case scenario. That's the second worst case. Here's the third worst case scenario. That was 1973. You had 2 consecutive years of down markets. So obviously it went way down. But after the 6th year, I'm back over $1 million. The bonds are at 824. And in 15 years, my bonds have completely, I'm broke. I've withdrawn this amount of money and I have no more. Here I'm withdrawing 60,000 inflation. Here's 13. And if you didn't live through this period, it was great, 12%, 13. But my balance continues to grow so that at the end of 47 years, I got 19 million bonds. I would, well, it's a moot point, minus 30. And it's crazy. I mean, it's just nuts. Now let's take a really good case. It's only 2 years. What if I started and retired in 1975, withdrew my 6%? Over 16 years, I would have gone from $1 million to 15 million. I'd have 897,000 in bonds. And it just starts good and goes up crazily, okay? So I cut it off in 1990. I think it would just go crazy. The fourth worst case scenario is 1990. We took a little dip, but here again, it grows and grows, takes a hit here. Here's a really good case. If I'd have retired in 1991 with $1 million, it goes nuts. 5 million in 29 years. So the point of this whole thing is at a 6% withdrawal rate, if you're invested all in stocks, there's only really 1 year out of 93 where you had been better off in bonds. Otherwise, stocks are good and you would have survived even in the worst case. Here, 20 years later, you still have half of your money and you've drawn $1.5 million to support your lifestyle. In my case, over 12 years, $800,000 in withdrawal rates. I'm back up where I was when I started. And after 2020, I'll be 900,000 withdrawals, and this is probably going to be a 1.1 number. Now, if you want to play around with this, it's kind of fun. We could put 7% in here and see how that looks. Well, yeah, there it goes. So it was 7% withdrawal rate. In the worst case scenario, after 20 years, I'm broke. Now I've taken $1.7 million out, but I've gone to ground. Would have been better off in bonds. The second worst case scenario, I would still be surviving. So I could have withdrawn 7%. In fact, that's kind of what I've done, actually. I haven't met my 6% target. I would have had still 795,000 after 12 years and have withdrawn 933,000. Third worst case scenario, I can survive for 31 years. I'm okay. Really good case, no problem whatsoever. Let's test that. Let's go to 8%. In a really good case, 75, no problem. What the heck? Let's go to 10. Again, no problem. So if you pick the right time to retire, you could push this thing to 8 or 10%. If you don't feel lucky, and feeling lucky is not a good financial plan, I'd stick with 6% as the good starting point. If you want to be conservative, 4 or 5% is probably better. But we can test this thing. But the point is that I picked out 3 cases where it might be a little iffy at the 6% level, but that's 3 out of 93 years, and I just can't find another time where the thing doesn't work out. So in answering my pressing questions, can I recover from a bad bear market? The answer is yes, and I've got experience 12, now 13 years of doing that. Would I be better off in bonds? 1 year out of 93, yes. 92 out of 93, no. What percentage withdrawal rate is safe? I think if you're all in stocks, 6% is probably a good number. 5 is a little easier to go with. If you find that you retired and a couple of years later things are going really great, you can push the 6% to 7 or 8 without a problem. And should I have dry powder? Not when I'm earning the kinds of rates of return that you get here. So I think that's a lot of data. This worksheet you don't want to see, it's pretty big, but I think I've answered the 4 pressing questions that I had about can I retire, how much can I withdraw? But again, this is based on a very disciplined withdrawal rate. I can take that 6% out, these dollar figures, I can get that, but boy, if I try to push it and take another 10 or 20 out just because I feel like it, or try to sell out because I think the market's going to tank, this whole thing goes to heck in a handbasket and it's no more valid. So it gives me a lot of comfort to look at these kind of numbers and say, yeah, you can compute this stuff if you're disciplined, if you have the advice of a good CFP. So that's really all I had to offer. Questions? I'd be happy to go back to the slide presentation and look at any of those things. If you want to play around with this, we can do all kinds of what if scenarios if you like.
Hi, I have a question. How does this mandatory IRS, withdrawal at 69.5, how does it come in picture?
59.
Right. Good.
With all this withholdings. Thank you.
Right. So one of the really good things to have is a Roth IRA. And if you don't have one now, you need to set one up, even if it's got a minimal amount in it, because you can, if you have an existing Roth IRA, you can transfer funds into it from a regular IRA. So if your mandatory withdrawal rate is more than you need to live on, you can merely take the excess, transfer it into a Roth IRA, and your investments that are protected from taxation remain the same. The alternative, of course, if you don't have a Roth IRA, is you can merely take that money out of your IRA, the amount that you don't need, you can merely invest it in a regular investment account. But of course, the earnings on that will be taxed, so it's not as advantageous. In my case, I'm still in a situation where the 6% for me is more than my mandatory withdrawal rate. As you age, you get into your 80s and 90s, yeah, it's going to be a real factor. But you merely roll the money out, spend what you need to support yourself, put the rest back into some sort of an investment account. The Roth IRA is the best alternative because it continues to earn things, earn money tax-free. But a regular investment account, nothing wrong with that too. Does that
Thank you
answer your
very
question?
much. Thank you. Thank you.
Yeah, people worry about the mandatory, but I say, okay, well, take it out. You got to pay tax on it. Okay, that was the deal. When you put the money in after tax or before tax, you're gonna be taxed sometime. But if you don't need the money, merely reinvest it in a regular commercial account or ideally in a Roth IRA. Most people don't understand that a Roth IRA has some real limitations on how much money you can put into it from your earnings. Or if you don't earn anything, you obviously can't put any money in. But if you already have an existing Roth IRA, you can transfer any amount of money from a regular IRA to a Roth IRA. Now you're going to pay tax on it because it's earnings. But, you know, like the mandatory withdrawal requirement, if you don't need that much, shoot, put it back in the, and we've done that several years now already in retirement.
Could you play this scenario with the conservative withdrawal rate, like 4%, and see what would happen?
All right, so if I take it out 4%, worst case scenario, I start with $1 million. I'm only taking out 40. 20 years later, I've got $1.8 million, and I've taken out $1.022 million. And I would have been better off in bonds. But that's the worst case scenario. Second worst case scenario, I get $1.4 million, a little bit better off in bonds. Third worst case scenario, it goes to the sky.
And how did you find out this worst case scenario rates?
I had the data on the rate of return for every year of 93 years. And I picked out the ones where you had bear markets immediately. That's the worst case scenario. So I just picked out areas where, okay, you retired and all of a sudden you got hit by with a bear market. So if you had a 4% withdrawal rate and you retired in 1975, I mean, it's crazy. So in 16 years, you would have taken out $1.1 million to support your lifestyle. You'd end up with 17 million as opposed to 2 million in bonds. I mean, I'm not going here. Sorry. So that was my whole thesis. Give me the worst, and this is actual data. This is what really happened. Okay, let's look at one. Yeah, this is my favorite because I've got 47 years of data here from 1973 to 2019, and you know that was a bad time. The next time we picked up was 2000, where you had these 3 years of down. And then, of course, here's your 2008, which is total disaster. In that year, you would have lost 15 million. But it comes back. So, yeah, if you would go with lower rates, it's all the more argument that you got to be in the stock market again. But it's got to be disciplined. You know, you can't take out 42 here and 143 there. I mean, not going to work.
Thank you. Any other questions?
So I promised something that I didn't deliver. I promised to give you my email address. Now I can't get the PowerPoint back. Huh. Sorry, technical difficulties. Yeah. Ah. There it is. So that's my email address. If you want to engage any more and have any other questions after you've thought about it, want to go back and look at that Excel sheet, put in your own information, anything like that, I'd be happy to talk with you. So just give me an email and we can discuss it. So Elena, that's all the inspiration I have, my friend.
Thank you very much.
Thank you.
As Mr. Hartzler said, if you have any questions, please email him and he will be happy to answer. And please keep an eye on our programs on our website. We will have other interesting programs on investment. So please stay in touch with the library. Thank you very much and have a good day.
Thanks, Elena.